Another day, another story. Public finance refers to the management of financial resources by the government to achieve its objectives. The role of government in the economy is to promote economic growth, social welfare, and stability. It uses various tools such as taxation, public spending, and fiscal policy to achieve these objectives. Taxation is the process by which the government collects revenue from individuals and businesses. The collected revenue is used to fund public goods and services such as infrastructure, education, and healthcare. Taxation can take many forms, such as income tax, sales tax, and property tax. Income tax is the most common form of taxation and is levied on the income earned by individuals and businesses. Income tax is a progressive tax, meaning that those with higher incomes pay a higher percentage of their income in taxes. Sales tax is a consumption tax levied on goods and services purchased by consumers. Property tax is a tax levied on the value of real estate owned by individuals and businesses. Public spending refers to the government's expenditure on public goods and services. Public goods and services are those that are not provided by the private sector, such as public infrastructure, education, and healthcare. The government funds public goods and services through taxation and borrowing. Fiscal policy refers to the government's use of taxation and spending to influence the economy. Fiscal policy is used to stabilize the economy during periods of recession or inflation. During a recession, the government may increase public spending to stimulate economic growth. During inflation, the government may reduce public spending to control inflation. An example of the role of government in the economy can be seen in the United States during the Great Depression. In response to the economic crisis, the government implemented the New Deal, a series of public works programs and financial reforms aimed at stimulating economic growth. The New Deal included programs such as the Civilian Conservation Corps, which employed millions of young men in public works projects, and the Social Security Act, which provided financial support for retirees and the disabled. Another example of the role of government in the economy can be seen in the response to the COVID-19 pandemic. Governments around the world implemented fiscal policies such as stimulus packages and tax cuts to support businesses and individuals affected by the pandemic. The U.S. government implemented the CARES Act, which provided financial assistance to individuals and businesses affected by the pandemic. In conclusion, the role of government in the economy is to promote economic growth, social welfare, and stability through the use of tools such as taxation, public spending, and fiscal policy. The government's management of public finance is crucial in achieving these objectives. Examples such as the New Deal and the response to the COVID-19 pandemic demonstrate the importance of government intervention in times of economic crisis. Thanks for watching.